All right, let's talk about a company that's really shaking things up in Singapore's real estate scene, Coliwoo Holdings. They just hit the public market, and they are laser-focused on one of the hottest trends out there right now, co-living. So let's dive right in.
But here's where it gets interesting. The company's initial public offering, their IPO, was a massive deal. I mean, the public offer was oversubscribed by more than 20 times. Everyone wanted a piece. And yet, after all that hype, the stock price actually dropped below its initial price. So what gives? We're going to break down a brand new analyst report to figure out if this is a classic broken IPO to stay away from, or maybe, just maybe, it's a huge hidden gem for investors.
To really get to the bottom of this, we're going to frame this whole explainer as a classic bull versus bear debate. On one side, you have the bulls, who are shouting from the rooftops that Coliwoo is an undervalued growth giant. But on the other side, you've got the bears, who are warning that this story has way too many risks hiding in the fine print. We're going to hear both sides, taking our cues directly from the report's analysis.
Okay, first up, let's hear from the bulls. The argument here is that the market is just completely getting Coliwoo wrong. They see that price dip after the IPO not as a red flag, but as a classic overreaction, which, can create the perfect buying opportunity. So what's the foundation for all this optimism?
Well, it starts with sheer dominance. Get this, Coliwoo already controls 19.5% of the entire co-living market in Singapore. To put that in perspective, that's nearly 1 out of every 5 co-living rooms in the country. They are, without a doubt, the biggest player in this space.
And that massive market share? It's not just a number for a press release, it gives them real power. Coliwoo gets to enjoy economies of scale. Think better deals on supplies and marketing that their smaller rivals can only dream of. Being the leader means you can influence prices and attract tenants way more easily.
And listen, they are not resting on their laurels. This is not some sleepy, old-school property company. Just look at this growth plan. The report lays out a super clear path for them to grow their room count by a whopping 36% by the end of 2026. And this isn't just wishful thinking. These are actual, secured projects that are already in the works, like that huge positive risk resort and their new flagship building on Middle Road. That growth is pretty much baked in.
So this is the kicker. This slide illustrates the disconnect perfectly. The market is pricing Coliwoo as if it's one of these other mature, slow and steady companies. But its earnings growth is forecast to be over 60%. I mean, look at it. It's all by itself in that undervalued growth corner. The bull case is simple. Investors are paying for a slowpoke, but are actually getting a high growth engine.
Wow, okay, that is a really compelling growth story. But now, we have to flip the coin and look at the other side, the bear case. This view says, hold on, that growth story sounds great, but the analyst report also points out some pretty important details in the fine print. And when you start digging into those details, some concerns definitely start to bubble up.
So, the first big issue for the bears is how complicated the company's financials are. The argument is that the main profit numbers you see right up top just don't paint the complete picture. And for a lot of investors, that can be a red flag. They want to see financials that are clear and easy to understand.
Take a look at this. This comes straight from their books. The official reported profit, what's known as PATMI, was $15 million. But then, the company also reports something they call a core profit of almost $23 million. That is a huge difference. Now, that gap is mostly due to some non-cash accounting stuff related to property values, and while that core number might be a better operational measure, having 2 different profit figures just makes things confusing and can really turn off investors who like to keep things simple.
Next on the list, debt. The report points out a net debt to equity ratio of 46%. Now, this basically measures how much debt a company is using compared to its own money. The report calls this moderate for a real estate business, but 46% isn't nothing. It means the company is pretty leveraged, and that just cranks up the risk, especially if interest rates climb or the property market takes a downturn.
And finally, the report itself spells out some very clear operational risks. First, a big chunk of their properties are leased, not owned. So if a landlord decides not to renew a lease, poof, that revenue stream could vanish. Second, like I just mentioned, all that debt makes them very sensitive to interest rates. And third, that incredible 36% growth plan, well, that comes with huge execution risk. Big projects can get delayed, costs can spiral, and that could really damage future profits. So yeah, the growth is exciting, but it is far from a sure thing.
All right, we've heard some really strong arguments from both sides. We've got the bull case, all about market leadership and growth that's on sale. And then we have the bear case, which is focused on confusing numbers, debt, and some serious real-world risks. So, where did the analyst who actually wrote this report land?
Let's just recap the dilemma one more time.
The bulls see a clear market leader with a massive growth plan that the market just isn't appreciating. The bears, on the other hand, see complicated accounting, a decent chunk of debt, and real risks that could derail that whole story. It's the classic showdown between massive potential and fundamental risk.
And the final verdict from the analyst is a buy rating. Yep. Despite all those risks, the report concludes that the stock is, in fact, undervalued. The analyst slapped a target price of 70 cents on it, which, when the report came out, suggested a potential jump of about 27%. The thinking here is that the market is just too caught up in the post-IPO price drop and the messy financials, and it's totally underestimating the massive scale of the growth that's already in the pipeline.
And that brings us to our most important slide. Everything we've talked about has been a deep dive into an analyst's report on Coliwoo Holdings, and it's purely for educational purposes. This is absolutely not financial advice. Every investment comes with risk, and you should always do your own homework and talk to a professional before making any decisions. So the big question is, will the market eventually see what the analyst sees and reward this co-living giant? Or were the bears right to be cautious? Only time will tell. It'll be fascinating to see how this one plays out.